go.
Streaming from South Africa to the world. This is the Stonks Go Moon podcast. What just happened? We break it down so you don't have to.
Welcome everyone to the Stonks Go Moon podcast. My guest today, Tim Vollans from Macrodesiac. Tim, welcome to the pod.
Hey mate, great to be here.
If everyone's still watching, I'm still protesting load shedding in South Africa. Not only that, our LTE has gone, but if you think South Africa is a shit show, you should see the UK at the moment. Tim, what the hell is going on?
Yeah, I don't know that we've got quite the same problems that you guys have got, but yeah, it's a mess. It's a mess, but I keep pointing people in the direction that it's not just the UK.
Okay.
You know, you've got to look at this in the global context of what's going on. All right, now, I kind of let's try and get this sort of framing right from the beginning. All right, so we're in a period now where we've got interest rates rising globally. Okay, obviously that's going on all at the same time, but at different paces. You know, if you look at, say, for example, where UK yields are versus where the US is versus where, say, Germany is. You know, it's kind of tracking, roughly speaking, the kind of the point we're all at in our respective hiking cycles. Mm-hmm. Now, obviously, what then happened in the UK was that we've got all of these derivatives. It's always leveraged derivatives backed by supposedly safe assets because they're all very safe and you know, and yeah, that's it. Always the same problem. And then we've then gone and sort of discovered actually they're not that safe. You know, and when you've got to unwind these things, because obviously there's a kind of spark, such as we saw with the fiscal plan, which we'll get onto, I think, in a minute. Yes. You know, you have that spark, and that sort of sets off this domino effect. Okay. Now, obviously, everyone sees these things, and they see it happening at the same time, and they immediately attribute cause and effect to it. Yes. You know, so this happened on Tuesday, then this happened on Wednesday, so Tuesday equals Wednesday. You know, that's sort of how they work it. And obviously, that's not what happened. You know, these things have been sitting there. I think there was an FT article, I think, written in June or July about, you know, this kind of these sitting ducks, if you like, you know, in a rising interest rate world. Because we've got a world that's leveraged to low interest rates, and all of a sudden they're not low anymore. It's like how fast this has gone. This isn't going to be the last sort of incident like this that we see.
I was about to ask you, because everyone is saying, or the popular narrative is that this is all political, right? It's actually very easy to just point fingers and say, oh, this is Truss, this is the Tories, this is, you know, XYZ, let's pit her against a lettuce and see who lost the longest, stuff like that. It's all like, it's easy to paint it as political theater.
Mm-hmm. And yeah, I mean, that's the problem. I mean, me and David were talking about this earlier. Yeah, you know, it's something that we're seeing now in the media, and we see it more and more and more. It is all created as if and sort of portrayed as if it's all political. You know, and you're like, no, that's not what's going. These people don't have that much power. You know, let's be honest. It's like, you know, the markets are there, sort of dictating a lot of what's happening here. You know, and these positions that get unwound, they get put on again. You know, like these pension positions, they, you know, like some of them they've been putting them on for like 20 years. Yeah. You know, because they're trying to match these things like 20 years in the future for when people are retiring, and, you know, what's the asset side, what's the liability side, can we make it balance? And that's part of the reason why they use these liability-driven investments, because they've got to fund that in the future. And that happens all because we talk about a few tax cuts. Really, that creates that reaction in financial markets based on, again, the kind of the rational economic human that we all sort of pretend that exists. Yes. Which obviously it doesn't. You know, it reflects the positions, it reflects where we are now versus what's where we will be in the future, and the kind of the best interpretation of that, and the positions they're on at the time as well when those things happen.
So now we've got this deleveraging happening, and basically we're seeing the effects in the market. So why does it matter in the bigger context? Okay,
so why does it matter?
Yes.
I mean, I guess that depends on the perspective, okay, and where you're coming from. I would say that at the moment, the way that I look at it, the way that the government has responded by going from, you know, we understand the problems with the economy are structural, which I agree with. You know, I'll be honest, I'll put it out there. I basically agree with the idea behind the plan, the whole Trussonomics plan. All right. Yes, I get that it's unfunded and everything else. And it was the wrong time to launch this plan, because What you really need to do is you need to do that when everything's really hit the fan, and
Yes.
everyone's looking down the barrel of like, okay, this is a really bad economic situation. Now we need to do something about this. That's when you then come out with like a big ambitious plan. Okay, clearly you don't do it when borrowing costs are going up, inflation's running at 10% and everything else. You're like, yeah, we're just going to spend more money, we'll fix it.
Well, timing is everything, right? Timing is everything. I mean, let's be honest.
Yeah, exactly that. So they do, the timing was awful.
Okay.
But the response since has been terrible because now we're just going back to austerity plans. Like, yeah, let's go to austerity because that's worked out really well and that's not going to cause any social unrest down the line. Like, we're talking earlier again in the chat group, one of the guys there, he's there and he's saying, like, me and my wife jointly have got an income of £100,000, which is a bloody good household income. Yeah. And we're struggling.
Ridiculous. It's ridiculous. Yeah. We've all learned a new word the last couple of weeks, and it's something like I think my American listeners won't be familiar with. It's gilts. I think if you could unpack for us, firstly, what a gilt is, and then what essentially happened like to that market, and then let's just go from there.
Okay, so basically, a gilt is obviously a UK bond. In the US, you call them treasuries. You're talking longer term bonds. Okay. So that's basically what we're looking at. That's what a gilt is. So 10-year, 30-year, that sort of period of long-term instrument. What happened was, because of the way the pensions are structured with these long-term liabilities, what they'd essentially done is they've built up these sort of leveraged investments and used the bonds as collateral. Now, obviously, what happens when interest rates go up is that the value of the bonds that are already issued goes down. People think that it's an immediate thing. That like, okay, well, that's it. If interest rates are going up, that's better for the pension funds because they can get better incomes. You're like, well, yes, but it also devalues everything they're already holding. And obviously, what happens is when you're holding that as collateral, it devalues the collateral, which means you then have to post margin for the person you're counterparty in this leverage trade with. In a similar way to, if you're like a retail trader, yes. If you're, the broker rings you up and says you've got to post some margin, mate, you're not looking too good. So
and this year they learned what a margin call is.
Oh my
God! If they didn't know, they got a few of those. So yeah, you were saying.
Yeah, so obviously that's basically what you're looking at. It's sort of collateral margin call, and they ring them up and saying this. And obviously, what they have to do to post collateral is they have to get cash. Okay. Now, obviously, most pension funds don't sit with a large amount of cash these days because cash was getting no compensation.
Yeah.
So what they're ending up doing is they're having to sell the same instrument, the gilts, the long-term bonds. They're selling that to realize it into cash to post the margin so they don't get stopped out of all of their positions. It's like a lesser of two evils type thing. But obviously it puts more pressure on the same thing because they're all selling at the same time because so many of them have got the same position. So it's it's essentially a position squeeze. That's really what you're looking at. And again, it came at the backdrop as well of the Bank of England saying, the timing of this, perfect timing as always. We're going to start quantitative tightening, which we're going to be selling into this market as well. So everyone, well, I'm not going to wait for them to have to start selling. Like I say, the whole thing was known about, the positioning was known about months in advance.
Yes.
That when rates got to a certain point, though, we're going to be vulnerable. Then you've got the Bank of England saying, oh, we're going to start selling gilts into this market as well. We don't think it's disorderly in any way. You're like, well, pay attention, guys, keep up. And everyone's trying to get ahead of the next guy. And it kind of, so you've got all of this perfect storm kind of doom loop that feeds on itself until the central bank stepped in and said, no, actually, we'll create this temporary facility to provide liquidity, which was always the problem. It was a liquidity problem, not a solvency problem. And that kind of has solved it for now. Apparently, the Bank of England yesterday, I think it was Cunliffe said, the deputy governor, he said that they'll be fine. Another couple of 100 basis points they can withstand now, which that's a sort of red rag to a bull, perhaps, and maybe we'll see some more of this down the line.
Yeah. Speaking about more of that down the line, is there any immediate or future contagion effects or risks for the UK and then looking outside of the UK to other markets?
I wouldn't necessarily say contagion to me tends to mean that it's sort of, something that happens in the UK causes something somewhere else.
Yes.
And yes. I tend to see the UK more as a symptom of this kind of global rise in interest rates. I think that what we're going to see now. Okay, let's just check. I mean, we'll take a quick detour just as a comparison. Okay, we've been pointing a lot at Germany lately, right? Now Germany sat there, right? Germany said, right, we're going to spend 200 billion, okay, on energy. We're going to spend another 100 billion on the military. And we've got another 60 billion there for sort of climate change funding and whatever else, you know. But we're going to keep all that off balance sheet. So we're going to keep it into what they call special funds, because Germany's got basically a debt break where they say they won't take on a certain amount of debt, and they don't want to break that rule. It's all in their constitution, all that sort of stuff. So being good politicians, they just sort of, you know, manipulate the rules and put it somewhere else, but they still do what they need to do. All of that sort of, there's been no talk about extra taxes for any of this to fund it. None at all. Where is that money coming from? And no one's saying a word. But obviously, you know, what we're going to probably see now, you know, the ECB is due to hike next week. That should be another 75 basis points, put them up to about 1.5% deposit rate. We're going to see that next week, you know, and they're supposed to be the linchpin of Europe, because the rest of Europe is, you know, generally so indebted, you know, along with Holland as well. But obviously, Germany by far the bigger economy.
Yes.
So you've got all of these things happening. And I think you're just going to see the same thing. The same issues are going to come out, not exactly necessarily in the same forms, you know, but the same problems with, you know, rapidly changing conditions will always cause sort of the, you know, you're looking at the liquidity tide going out, you find out who's swimming naked, you know, and there'll be plenty of people that are swimming naked because obviously they're all swimming the same way for 20 odd years based on this kind of low interest rate environment that we were supposedly never going to get out of. I mean, Austria, they launched a 100-year bond in 2019 at like 0.3% interest or something ridiculous. And everyone was just basically, oh, great, we'll buy that because at least it's not negative yielding. You know, and now look where we are.
King Charles must be kicking himself. What a shitty time to take the throne. I mean, talking about timing, it's just like, I can't win. I can't catch a break.
Yeah, I mean, luckily he's probably not going to do a great deal, to be honest. You know? He'll just sort of, you know, talk about climate change a bit and do a few talks. But yeah, as a government, you know, the worst possible time to be taking over.
If you are an investor in the UK, specifically if you are invested in UK funds, should you be worried, or is it sort of too late to be worried now?
Yeah, I would probably say it's probably a bit too late to start worrying now. I mean, really, there's, you know, it's always obvious in hindsight, but at the time when we were running with inflation so far out of whack with what central banks were doing, you know, that was probably the time to sort of basically say, right, I'm gonna draw down some of my positions. I'm going to move into cash. You know, I'm just going to sort of reduce my risk essentially. That's what I'm going to do now. Okay. You know, now, I mean, potentially what we're going to see now is that maybe people do start doing that, where cash starts to yield something as well. Okay. You know, if you can put it into sort of money market funds and those equivalents of sort of short-term cash funds, not necessarily in the bank, because the banks won't necessarily pass the rates on, but there will be instruments that you can put it into. Then obviously, yeah, you can put it into that and earn something back at least. But yeah, as far as the investing environment goes, it's pretty bad everywhere. You know, I don't, you look around the world and you think, okay, so where should I put my money that's not going, where am I not going to lose money? And there's really not many places you can look at this year that's actually, you know, not lost money. It's been pretty brutal across the board. But we've got to put that into context of what happened in the past 2 years as well, of course. You know, we've had these extraordinary gains, and then we're just sort of drawing back down on those. So it's not necessarily a crisis type thing or anything else. It's just sort of a particularly volatile period. And I don't think it's going to get much better until next year. You know, so middle of next year, perhaps we might get a bit more clarity on what's going to happen with inflation, where interest rates are, whether they're going to have to stay there, or whether we are going to sort of see a cliff edge. Yeah. Which I think all of those things are possible. I think you've got to assign pretty equal probabilities to those things, because I think we could end up with a very sudden stop based on what's been going on. But likewise, it's also inflation's everywhere. It's kind of entrenched, so it could continue.
Set a bit on cash. Yeah, set a bit of cash. Just be patient and kind of wait for the turn.
Basically, yeah, that's it. You know, just reduce your risk. Make sure you're not leveraged up, and yeah, wait it out. You know, markets. We've been very fortunate for a long time. The markets have always gone up. You know, whether it be it bonds or be it stocks. You know, there's always been going up, and now we're in a period where they're both going down at the same time. It's part of the natural sort of cycle of things.
I absolutely agree.
Yeah, you just gotta wait it out and hope for the best, really, because it's not like there's an alternative for the moment.
Tim, before I let you leave, I want to ask you your opinion on what the UK government should be doing right now, or what should be the next sort of step to calm everyone's nerves.
I mean, to be honest, I don't know there's much they can do.
Okay.
I really don't know there's a great deal they can do. Just basically, I suppose, not going ahead with the unfunded tax cuts that they've already done, making sure that the energy bills are going to be sort of covered, and we're not going to be, struggling with that next year, and people are going to be defaulting en masse and not able to pay for things because energy bills are through the roof. Those should probably be the priorities, really. Beyond that, like I say, I tend to believe that we're going to have a deeper restructuring of the economy, and I think that's probably going to come from the government side, and that's where we might see a plan similar to the trust plan come through, where we're going to see, because I'll just explain that into a bit of context, that what I think we're starting to see more and more of this kind of reshoring and sort of nearshoring kind of initiative that's happened, started happening already. People are moving away from China, for lots of reasons, not just geopolitical reasons, but the advantage that China had just isn't as big anymore. Yes. They've got their own economic problems as well, which probably means they're going to favor their domestic companies increasing, even more than they have already. So I think that move of all of these industries and everything to Asia, I think we're going to bring that back now closer to home, and we're going to sort of try and increase the size of our own economies. But obviously that's going to take like 5-10 years, before we can really start to see, oh, that happened. And sort of really notice it. And that really was what the sort of trust plan was generally about, was trying to get more business domestically. And like I said, I think that will happen everywhere in the West. I think we're already seeing it in the United States. They're in a particularly favorable position at the moment. Europe's not very competitive with the energy costs and everything as well. So I think the US is very favored there. But obviously these things are long-term trends, and the US can't just keep necessarily putting everyone else out of business, basically, because they need to keep Europe going. They can't just keep with the dollar going as it is, and then go, and we'll make our economy even stronger, which will make our interest rates even stronger, and so on. And Europe's just going to crumble, basically, if that happens, which obviously isn't in US's interest either.
No, not in the West's interest. But long-term trends are not politically popular, right? Because it's what can you do for me now, and what have you done for me lately? And I think that's what the issue is, because everyone's looking. And do you think the Tories are in trouble, or do you think that there's another political party that might come into power?
Yeah, I mean, I think you can definitely see Labour coming into power, but again, they're not the solution. I think we've got the same. I think we kind of, the way that I could see this playing out, whether it becomes a new political party, which is always hard to get off the ground and get started, really. A lot of people talk about it, there'll be a new party, will just come in, as if you just make it, you start it from nothing. Yes. I mean, even UKIP took like a decade to really make inroads. So I think you'll probably see, maybe if you're going to see that kind of division, you'll see a faction that will kind of break off from one of the existing parties. And they might come with a new plan, a sort of fresh thing, disassociate themselves from all of the kind of negative kind of history that we've all got. We've all got our kind of mental scars that they've let us down over the years. So we can't trust them and everything else. So it needs a new party to kind of be formed, so that we haven't got all of that old negative attachment, and we can believe that they might actually do what they say they're going to do. And then they can come in with some more radical ideas, and the people can kind of get behind them. But I think for that to happen, you've got to see some real pain first. You've got to see the people really unhappy and rejecting this sort of orthodoxy that we've had, over the years, that sort of has just led to nothing. Because I mean, the career politicians are everywhere. They don't do anything, tangible that we can really look at and say they've done this thing. We've got this kind of big system that they all inherit, which does keep the lights on generally. It keeps us all, we're all. I mean, if I say generally, maybe not for you guys at the moment, but
there was
but it just about keeps us surviving.
There was a LinkedIn post the other day where there was a bit of banter, and someone said, if we replace half of the politicians in the cabinet with pineapples, at least we can ferment them down and make pineapple beer, and we can ferment it further to make fuel. And I was just like, yeah, that's actually, now we're talking about something useful. Tim, thank you so much for joining me today. If the listeners want to connect with you and find out more about Macrodesiac, where can they do that?
Just go to macrodesiac.com or follow me on Twitter at Volatim, VOLA Tim. Mainly on Macrodesiac. I'm right there every day.
And go and follow him and David are very, very funny Twitter follows. Their banter is excellent. Tim, thank you so much for joining me. To our listeners, peace, love, and prosperity, and we'll catch you in the next one. Cheers.